Good morning, everyone. Welcome to this live session. Happy Monday. It's almost the end of September today. Very excited to have some special guests. So we have Dan. Many of you already have seen some of the lives we did with Dan in the past. So Dan, very experienced option trader. And together we join with Amin Kribi, founder and CEO of EarningsWatcher. And then, of course, you're going to introduce yourself, Amin, but very excited to have you because today we're going to show you how you can combine a couple of tools to look at earnings. So we're going to focus on earnings. So very excited to have you. Welcome, Amin, and welcome, Dan.
Thank you, Fabio, for having me. Glad to be here with you. And then, so just a quick word for your audience. As you explained, basically, I'm founder and CEO of EarningsWatcher. We're really a platform focused on earning strategies. So perhaps not a lot of people know, but earnings are a great edge in the markets that actually rely on data. And so when we follow basically what the data has basically showing us in the type of analysis we can do, it really opens up these data-driven opportunities for different kinds of strategies around earnings. So perhaps people are familiar with the classic, directional picks going upward or downwards, but it goes even further, as Dan will show you and we'll discuss, from profiting from IV crush or betting against IV crush, playing the IV rise before the release or momentum after. So as you can see, plenty of things to do. And when we follow the data basically and really rely on this agnostic and data-driven aspect, it really makes for a great age in earnings. And so happy to be here. Thank you for organizing this, and glad that Dan will show us, as you said, a concrete example of how to combine both tools to prepare and calibrate these types of plays.
Yeah, exactly. And today, I think we're going to go straight into you, Dan, because I think it's very interesting to show how to put these tools into action, because a lot of the earnings play, people tend to maybe lose money because they underestimate the data. So if you underestimate the implied volatility or underestimate the potential move of the asset, then of course you might be left with a losing trade. So we're going to show you some things today that can help you maybe prepare for earnings. There's a lot of interesting company reporting in the next few weeks. So I think it's going to be very, very, very interesting.
Yeah, I'm happy to be here, and happy to share my passion for earnings and everything which has to do with earnings. And I'm happy basically to show a bit just an approach how you could do it. But you have two amazing quant data tools here at your hand, and this is a very special session we're having today. And I'm very happy that Amin could come here, and not only we are able to show what EarningsWatcher is doing, but to be able to combine this with MenthorQ data. So I hope everyone can see my screen. So this is basically, if you start here in EarningsWatcher, you have a lot of things here you can use, and amazing stuff is hidden here, the same as with MenthorQ. But we want to concentrate on earnings today. We have done a lot of sessions on earnings and talked about earnings and my approaches, and some of you might have wondered how I did some things. You have followed my trades, and today I will there's no secret behind that. It's just how you can use data. So for this week we have a couple of earnings. You see we have IV Rush. Everyone who has followed some of our sessions with Fabio knows what IV Rush and IV Crush is. Very short flashback before earnings. IV ramps up, which means implied volatility will go higher and tends to go higher. And these IV Rush here just takes advantage to show us when you can enter in the right moment and to take advantage for 5 to 10% little plays, but they accumulate. They can basically exponentially grow a lot, and you can make a lot of money on that without a lot of risk. But today we want to focus more on other stuff where you can combine basically the two data sets we have here, one from EarningsWatcher and one from MenthorQ. And where is that? Basically, this is mainly on the earnings event. So how can you calibrate a setup on the one hand, and after an earnings event happens, IV collapses normally. This is what we call IV crush. How can you prepare yourself for management of your trades? Do you have to do anything? Where are maybe some interesting levels? And MenthorQ gives us these levels where maybe a move can stop. And the other thing, and not only but you can also play what happens after earnings, which is the peak, the drift. You see here, there's the drift lab. This is something also like the IV ramp in the beginning, something special you can do afterwards. But again, there, MenthorQ helps you to see where maybe a move of a stock can historically, let's say Tesla, if it drops for the next 2-3 days. Let's say I just made something up, and but you can see that we're close to some important level, and MenthorQ shows you this level. So maybe from this level on, we have a bounce, or if this level is breached during earnings or slightly after earnings, we go down further. Why? Because market makers have to buy into rallies and sell into the abyss, which opens sometimes for some of the equities. So these are very special things, but today we want to focus on what you can do in the main event, because there lies the money. This is where people bet a lot, and Fabio said it, put it in the correct words. These are the bets, let's say it like that, which a lot of people lose. Yes, you can see a lot of people saying, I had a call, I had a put, and I made 400, 500, 600%. Yeah, wow, this can happen, but statistically, most probably you're not going to win on the long run. That's why I like the EarningsWatcher approach. There are levels which you can respect, but you have, from the historical view point of view, you have data which shows which stocks move more than the implied move and which stock move less than the implied move on average. And this is factored with many other data sets into some actionable things. And if we concentrate on what we have in the middle, we have short volatility through earnings. So we have an earnings event. And in this earning event, this is maybe the time, let's say, take Costco, which reports on the 25th, which is, if I remember correct, it's the Thursday. We'll report after market close. This is a position we can take where we sell options, and either we do that naked, or better, you do that basically with a foreleg, maybe an iron condor or some butterfly, or we do some calendar. We can look into that later. But this is where we sell options, because normally this stock tends to move less than the implied move. What is the implied move? It's what the market has priced in for this stock to move. So basically, you can see here, we have a beat rate. We have some amplitudes of beat versus misses, and you have everything you need here. So on the right, you can see also, is this basically a stock which basically really never beats the move the market has anticipated? No, we had some bigger moves in the last 2-3 years. So this is something we have to be more cautious. That's why I love it here. It's very simple for traders which are very experienced. This is something you can do. You can set up. But if you are a novice, or you just want to play safe, then maybe you should focus on the green ones. And how can we make this better? Let's open this here and go into the moves. This is something we have a lot of data here since 2013. We will focus on the last 2 years. So this is something which I like. So let's see.
I think perhaps your
yes,
didn't change then when you moved to.
Yes. Oh, sorry. Yeah. I have to change the tab. Sorry.
We opened. I wanted to jump into
yes.
Great a way to explain basically the strategies. And so just to add quickly some context, what Dan summarized here is exactly sort of the edge of earnings. So as you all know, stocks move on earnings, basically. So the reason why IV rushes to inflate this implied move, as Dan says, is really to account basically for historical moves. There's no free lunch. The market will not let basically people profit from these big moves without pricing it in. And so you see this aspect of the rush leading in. Just before earnings, we have this implied move that basically it summarizes the expectations of the market. Again, in terms of amplitude, really not direction. This is part of the advantage that we focus on this metric of the amplitude of move rather than how to pick upward or down. And basically, you see here where the data edge and the statistical edge comes from, because we're basically ending up benchmarking or analyzing the current expectation, the current implied, versus what happened in the past, the past moves, the past realized, the different metrics you were looking in, and from looking at, and from that we can calibrate, as you mentioned, positions, whether naked or four-legged, etc. And the really good thing here is that we can know what we're getting into and basically really calibrate our risk reward, not just as you mentioned, buy a call and wait for a huge 600-700% return. Here we can do this really more seriously, and so prepare for each scenario. And as you said, data can help us really pinpoint which are the names that are more likely to be good candidates for this implied move, as you said, being overvalued or undervalued. And then what I really like, and this is why it's a very concrete workflow, Dan, is that you combine basically what you find on EarningsWatcher to data from Menthor Q to push your calibration and your research even further. And so this is basically what we're looking at. Just wanted to give more context for if people are not that familiar. So thank you, Dan. Back to you.
Yeah, thank you. I mean, this is so helpful because both of you have so much knowledge on these things, and I will look through the lens of a trader with this setting up the trades, but you're the ones who created this stuff, so it's very good to get some context. And everyone out there watching now or later, just shoot us questions. So we're here to answer this question. So if we take Costco here, this is from 10 years. I said I normally look at the 2 years, but we had the average move of 3.74 and the implied move now is 4.10. So if we go back here, we see that basically Costco is a good candidate, and I want to show you here how I will start digging. So on average, we have the 4.2, and you remember that we have an implied roughly the same, a bit higher. So that's why it's very close on the edge, because we had some bigger moves. Always talks about the fat tails. I remember correct. This one's here, which can ruin the statistics. You see this one and this one. But if we, to be fair, if we take the 4.3, which we had in mind as the basically implied move right now, if we can stay in that range, and we normally stay in that range, what will happen? Options are expensively priced due to the IV rush if we sell in the last 15 minutes, for example. And the good thing is that if we stay within the range, normally already on the first day, we're going to make a very nice cut, and we end up there. But the question is, how can we combine this with Menthor Q? We have to look at different things. But before we jump over to Menthor Q and see how we can bring this data together, maybe 2-3 other things you should look at. I like looking here at the average and the standard deviation. So this gives me something in my head, which is like a 6.5. potential move, and I will be looking at Menthor Q. What happens around this 6.5%? Are there any important levels there? Is there something after the earnings which might stop a move there? Because then I know what my loss would be if we go above that. Or is there a level roughly around 4 or 4.5? We will bounce back. So this is something which will give me more chances of setting up a winning trade. I think you wanted to add something, Amin.
Yeah.
Or was I?
Great analysis, and so as you see, really here, what you're trying to do is you assessed how the implied compared to the actual outlook and what happened in the past, and it's really important to really note and understand all the potential scenarios, especially the bad ones. So to prepare ourselves, what, as you really said, what will happen at this level of move, say an extreme move on a right move. Overall, we'd like, again, to be guided by data. And so another metric that's good to look at when we consider these, what we call short volatility, basically betting on IV crush, that the market expectation is correct somewhat, the move will be under it. What you see here on Dan's screen is these two numbers where basically in the time period we selected, and here we think we're looking at 2 years, we really do a simple math of saying, okay, if the implied move is actually beaten, so this is not our good scenario, this is the bad scenario for short volatility and selling options. What is the amplitude of that beat? How far, how much did the implied go under, how much did the actual move go over the implied? We see here it's around 1.1. On the other hand, we'd like to know, okay, when the actual move, so really rise move, did miss the implied, and so this is the good scenario for us. The implied move was, as we expected, overvalued. Well, we see that the value by which it misses, so the implied ends up being more or highly more priced than the actual by 1.9. So we like these ratios where the right number is bigger for short volatility. It really means that even if it beats it, even if the actual move beats the implied move, so the bad scenario for us, the amplitude is not that huge. You know, it basically beats it, but not so much. So here it will either lower our losses or open up opportunities to handle the trade, as you mentioned, Dan, post earnings and see how the drift, etc. go. But really, just another example of how to really rely on data to know I should avoid this name or this is a good name to play for each strategy.
Yeah, thank you, Amin. So one last thing, and then we will jump over to Menthor Q. So from historical points of view, we have a slightly higher tendency to go up, and this is something we will see also in the go down, which we'll see in the Menthor Q data. So from everything we have shown you, Costco was a very stable name. Everyone around here at EarningsWatchers, maybe also at Menthor Q in the beginning, who used the 5-day swing model, made money with it because it used to be stock which never or hardly beat the implied move, but then it started to behave a bit differently. Economical things change. So another thing we should keep in mind that this is a good play, but this is not the perfect play. But that's not bad. We can, if we want to play that, then we will also look what Menthor Q gives us, so we know where things could even go worse, or for the best scenario where we can calibrate our stock. And we see here that we normally tend to go down. This can mean something, but this doesn't mean always something. So let's go over to Menthor Q, and before we deep dive into volatility risk premium and what that means, let's go back and take a look at this here for all these people from EarningsWatcher which have never seen Menthor Q. Menthor Q works with levels which derive from open interest. Please correct me, Fabio, if I say something wrong
Sure.
here. And basically puts these into intelligent models which predicts where price movement can happen, where basically price will go, or where prices are sticky and so on. And what I also know from personal life trading is that all these levels are great, but earnings day or the earnings event is something special. So the algos kick in and things can be a bit different, but from the backtesting Fabio has shown many times, these things are very highly reliable. So on the long run, statistically, you're always gonna win, at least from my statistics I have seen, if you take these data sets and everything Menthor Q provides into your calculations, and combining these two, how what is important here? So we said we have Costco. We want to do a short volatility trade, which means we want to sell options. And if we just look at the Q scores, this is a very, very easy way of just picking up where is that stock. So the opinion of this stock is very low. The market has gone up lately. Everyone is happy until we burst, or maybe not. I don't know. We might go to heaven with this market, and everyone is expecting a, a catalyst or something. But you dance as long as the music is playing. That's the thing. So volatility is high. This is super easy. Why? Because it's ramping up. Because we have earnings. This is very simple. Or if we didn't have earnings, that would be something is happening, something bad has happened, and still it can be a good moment to sell volatility. Seasonality is slightly negative. So these are some things you can take into consideration when setting up your trade. As I said in the beginning, normally I prefer non-directional trades because you never know if there's a surprise, a good surprise for the stock still may fall. We have seen that with stocks or vice versa. So if you set up your trade roughly around these numbers EarningsWatcher gives you, and you take MenthorQ data to see where are the important levels, do they align, then you can switch around a bit and maybe have a very perfectly easy strangle, for example, or an iron condor, or basically you go with a butterfly and it's roughly, let's say, 4.5 or 5% on each side, or you can skew it because you see something in the data. Either you find on EarningsWatcher and on MenthorQ, or you find on MenthorQ because you see there are changes. We will go to the intraday data in the end, but you see changes which show that the market is prepared to hedge there or is seeing some things coming in more negatively.
And I think
before we
I can add
yes,
that Dan, basically, like what we've seen, what you showed in EarningsWatcher was, if we look at the past, how can we get very good statistics on what could potentially happen? Because typically the past tend to predict also some things that happen in the future. We focus on the option market because the option market is a perfect sentiment for the future, because investors, big hedge funds, big institutions, they take positions using option data because option data can predict where you're looking to position yourself. So whether you're hedging, whether you're betting for a big move. So understanding how the option market is pricing in is very important. And of course, nobody can predict the future, so anything could happen, as you mentioned. But the option market is a great sentiment indicator for retail traders.
absolutely. So if we take this into consideration, that everything which happens in milliseconds is weighted, and the professional traders and all the algos and everything take that into consideration. They position themselves because they have long going positions on and so on. The earnings is something which can make people a lot of money or can take a lot of money from institutional traders, which basically they don't want that to happen. So a nice thing I always do is to start to see the DEX chart. We won't deep dive into the DEX chart, but it's basically something which gives me a very easy way of taking a look at this market. Is this equity for earnings, for example, is it balanced or not? And we can see here, we can see some. Just keep it simple. We see positive DEX here, negative DEX, which means on both sides, just to keep it simple, it is somehow balanced. It is somehow balanced. You see, maybe a bit more red here. That's why you see also here the moves here, and you see, okay, we have our put and call resistance level. How could it be? Magic numbers 1,900. We have the high volatility level, but we get a slight understanding that this positioning for the market is a bit more negative. The momentum is bearish, the gamma condition is bearish, and what I always like to take a look at is the 5-day swing model, which gives us a prediction, a roughly prediction, where will we be in 5 days. So in 5 days, the move will have happened. And the model predicts with some success level rate here for the upper and the lower band of 87.5%, that we will be at least below 985.57. So this is something to take into consideration. If you want to go directional, which we don't advise, basically, then you could bet that most probably these earnings might move to the downside. And then if you take EarningsWatcher, you go roughly 4.3% away from the final price on the 25th before the market closes, and you place your bets. Let's say you open some call spreads, very easy. I wouldn't sell naked calls there, or you can buy a put if you really want to do that, but also, again, not advised. So this is something which I would take into consideration to maybe skew this. Or what I love to do is, and I've been talking a lot about this with Emma, is set up. If I know the move is not that big, short volatility trade, and then I would like to set up a calendar because, and what calendar would that be? Would that be a call or put calendar? It would be a put calendar, because a put calendar, if we go down, is more resilient to a move. But let's not make things more difficult as they are. We got some data we wanted from EarningsWatcher. We still haven't got all the data we need from Menthor Q. So you see here a lot of data here. We can make this a bit bigger here. For example, this is the next expiration we are looking at. So again, we see here the call resistance on 1,000, but we see the put support now. The general put support is a bit higher, and the spot price is squeezed a bit, not in the middle, a bit on the downside. You can see it here. So you see, it could most probably, if we set up something here and we set up something here, then we need to see how far that is, and we most probably going to skew that on the downside. So we have a little bit more room on the downside than on the upside. So we take a bit more premium, and most probably, as EarningsWatcher showed, we move a bit slightly more downside, and MenthorQ give us the data, but we're going to keep it simple in the beginning and go on to look what else the market is giving us. So what do we see here? If we take a look here, we see how the GAX and DAX has changed. So this is basically positive on the total exposure. If we go here to the earnings we're interested in, we see that the exposure is slightly negative, and that is moving here. Do institutions bet that close? No, normally institutions go out 2, 3, 4 months because they don't want to take risks that much. Retail traders will take shorter expirations. So this is something for us to understand, that on the short term, this stock looks that the market is betting for it to go down till the end of the week. So Thursday, we have the earnings event. On Friday, last day of the week, the market expects this stock to go down. On the whole, we're still here in a more positive environment. This, you see how I try to balance the things. And the easy thing would be you take the data you got from EarningsWatcher and set something up on the 4.3 level, but you can enhance this with MenthorQ data. So I think it's worth now jumping back to EarningsWatcher to see where these 4.3%, where would we end up? What would be the numbers? And then go back to MenthorQ to see which levels are there. We saw 2 big levels here, but we have more levels on MenthorQ, and these levels can play a role after the move has happened. Because if some important levels are breached, then the market makers they have to act, and the market has to act. And people who have open positions there might close positions if they are winning, or they open new positions to hedge. So these are all things you have to take into consideration.
This is actually a great point then of how you use this data to really calibrate your position. So you're seeing where the levels are. You can also, perhaps, as you mentioned, skew it a little bit, all driven by the insights you get on MenthorQ. And this can really help you be more or less comfortable with, okay, a short straddle, a short strangle, four-legged things. So really incorporate that into how you would go through earnings, what position you will choose. Of course, as always, analyzing also risk reward and being comfortable that, okay, this is something I'm comfortable going through. But it's really great to combine the data from MenthorQ to know where is the, how can I position myself, what break-even levels suit me given the outlook.
Yeah, absolutely. So if we want to keep it simple, we have here the strategies which are pre-selected for us, which is wonderful. I can only say this again. This is the only calculator I know which properly, at least calculators I use, and I've used a lot, which properly factors in IV crush and all these other stuff. No other calculator does that. So for earnings, for me, this is a must. So, but if we remember what we said we want to be a bit balanced, but see the risk more on the downside. And for example, we have some things here which will help us. Don't be misguided here. And this is always the 10-year, which gives us more range, more data, more, how can I explain that? You have a bigger data set and you should feel safer. But I found out, and we have talked a lot with Amin, that as the market is becoming, it moves more, has become differently in the last years. It's more efficient. Using the 10-year is great for a general analysis. Using the 2 to 3 years is super good for finding the right balance for a proper trade. And if we go here and we see that we talked about 4.3 being the implied move, this would be something we could take into consideration, because we expect most probably what we saw from historical moves, and especially from MenthorQ now and the 5-day swing model, if we want to keep it simple, and from the other stuff, from the other data we have there, that most probably we're going to move most probably down. This would be something which is okay from the risk reward, because we have 4.5 and then it's breached, and 3.6 on the upside. Yes, if we go up, most probably we could lose there, but we don't want to talk about these things. And maybe if we do a follow-up session or something in that sense, that could be something where we can talk about what you do on a day where things go wrong. I won't go out in time because we want to sell expensive premium now. If I look into the butterflies here, I see these butterflies, which would make more sense, but we see here that most probably we don't stay in the ranges where we want. So I would do something very simple in the beginning. We remember, just to go back, we remember for the closest expiration, we have the 1,000 and the 920 put support. The easiest thing would be, in the spot prices here, to set up this here. But you will see that this, let me just go 1,920. So we would sell the 1,000. 920. This is a naked strategy. So beware of that. But where are the breaks here? And this is what I like here. This doesn't help us on the downside, because we saw that most probably going to go down. Like on Friday morning, Costco might be up like 10% and everyone will say, well, he said they're going to go down. No, I said this is what data points and historical data points, but this is something which wouldn't make us that happy. If we have a higher move,
I think
yes,
you need to
in the end,
Dan, the new screen where you're at. I think you need to reshare the new screen where you're at.
Okay, very sorry, guys.
No
okay, I will do that again. Yes, I would choose the 1,000 here.
Yeah,
and
so
the 900.
Proposing basically a short position here on the simulator. As you said, this really the advantage of this is it models IV crush for any option, any expiration. So we do this logic of finding out where IV for that specific option will drop, and so you can either use these preset strategies that you showed or freely compose any one. Here you compose the two legs that you've seen driven from MenthorQ data.
Yes, so this is here pre-selected stuff. We can just easily select and calibrate on that, or we can do something here. So I just took the MenthorQ data we had, which is just very, very pure data. And this shows me here that I'm not properly balanced from what I'm seeing. This is not something I want to be in, because if we have a high downward move, look at this. We got, let's say, roughly 1K, and we're down 2K in the end of the day. If we have a big move, if we have a low move, we're still fine, wonderful. If we have a low upward move, we'll still can keep our K. And if we have a high move, we still can keep our K. This is just statistics. If it goes, you see here on statistic, this is high likelihood of success, but risk reward is warning us. So basically, we saw in the data that yes, the most calls are sitting and the open interest is sitting at 1,000, but we saw something else. And let me go back here to MenthorQ, and then we can see how we can bring this together with the statistics we got from EarningsWatcher. Give me a second. We saw here the 5-day swing model. We have talked a lot about this with MenthorQ users, that this is a very good indicator to give us a slight sense where the market will be in 5 days. So yes, we're selling this Friday because we are selling options, not buying options, but let's try to calibrate our trade here. So our trade 985, we go back here. So we take out the call side, 985. Let's see how we're looking here. And you see here, this is the Ivy crush, roughly here. So this looks better, but still I'm not happy. Why am I not happy? Because I feel exposed here, because I think normally with what I've seen, we could go further down. So I need to do something on the short side. So we had seen this, and the 900 is what we saw. And I'm sorry, guys, that I always jump from one to the other. But the 900 is the general put support we had here, which is a very, 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 very strong level. Okay, so let me go back here. So let's see how this looks now. And this looks a bit better. So, I mean, I would say this is something which is in the range of our 4.3%. We get some decent protection down, some decent protection on the up. So in our book, with the implied move, which is 4.3, the average here is 3.7 on the 10 years. Risk rewards doesn't look bad. Likelihood of success doesn't look bad. And you have seen, this is a naked position. I would most probably, for long positions, I do like to buy naked options if I'm on both sides. I don't care about that, to refinance that, because I believe in the data I have on these both platforms. But for short positions, especially for novice traders who, if a big move happens, they don't know what to do. They just see this drop and they don't know what to do, and don't know how to read levels and what happens. This is just for demonstration purposes, but this would be, I don't know, Fabio, I think we used your data perfectly to see what we could do with the closest data we have from EarningsWatchers. I don't know if you guys want to add something, otherwise I would move on.
Yeah, no, of course. And I think what the most important part is the process, right? So you find it, repeat, and of course you look at statistics. So you cannot be right on 100% of the cases, but if you can build enough trade ideas that can actually make you right on 51+% of the cases, and you manage your risk accordingly, then you could have a successful strategy, I guess.
Exactly. I think it perfectly summarized it. It's really, as you people know, trading is not about one trade or one specific position. It's about the overall approach, the process that can be repeatable. And I'll just end up by saying, rebounding on what Dan just said, that's really spot on. Guys, if you are novices or not so comfortable yet, or even perhaps comfortable with this process, but not with handling basically how to treat a position after it happens, really avoid these naked positions, because as Dan mentioned, if you caught a big move that is, in a sort of a black swan event, more comfortable traders, as Dan mentioned, and as he does in perhaps you see in other workflows, etc., how to manage basically after the release using other data and basically handle that position even if there's a big move. Otherwise, it's better to be more conservative, cap your losses, etc., and slowly basically learn these techniques. But the most important thing is being guided by data is really the focus here, where you're relying on actual insights that come from smart analysis and research, etc.
Yeah, this is well summarized by both of you. So I want to point something else out. We have these trading view levels here, and these levels are very good, especially if you want to manage if something happens. And we're going to talk about that too. I hope everyone can see my screen here. These levels here, can you see them?
No,
I'm on the MenthorQ side.
Yeah, sure.
Okay, hopefully you can see. I can't make them bigger here, but these levels give you context. These are other gamma levels, which can give you context to see where the move could stop or where the move might accelerate. So what else can we take from this? From these levels? Let's say we have built this position here. We have a breach of the around 890 or at 992. If you remember, we talked about a put support, very simple, or put reaction zone, how I like to call it, and the call reaction zone. If these levels are breached, normally market makers have to sell into the decline, and they will have to buy into the rally. So if we have a huge move, and let's say if we have an upwards move here, you see a big move here. You can see it here. A big move would be on the day 6%. Then we have a bigger loss, and which happens here. And this is above 1,000 most probably. We have two scenarios here. You should remember, these levels are magnets. Why are these levels magnets? Because we have a lot of open interest there, and these levels tend to, if we get closer to them, to be that stock is basically driven to them, but it's very hard for them to break. On earnings events, these levels do break. Yes, they do break. So what would I do if I had this position on? If I had this position on and I would see that already in the pre-market that we're going to have a breach here, in the beginning, I wouldn't do anything. Why? Because we have seen it so many times that if the breach is not big, normally we go below this level again. If we stick there and stay above these level, let's say the 1,000 level, which is the call level, then yes, either you take the loss or you try to roll up your losing leg and roll it out of time just to make up for the lost money. But this is more for another session, and this is something you should be ready and prepared of. So if you know the levels before, then you know what to do when something happens. So in the beginning of this session, we talked about the peak, which is the move after the whole thing has happened. So this is something we can briefly look into in the last couple of minutes. We have, again, if we go here to the last 2 years, just for simplicity, you see here the average move is plus minus 1%, which is very low. But if you remember, 1% on 1,000, you can calculate that in your own head. If you have this in mind and you know the levels, then you know that the chance is there that in the next couple of days, we have a drift in the direction of the move. Let's say we moved up 6%, we breached the call wall, and we are staying there, then the chances statistically are higher that we stay above that. So even if you roll out in time, or this would be a trade you took on a Tuesday and the expiration is on Friday, and this trade happens on Thursday, but let's say it was a trade we would do today for tomorrow, for example, and you would see some time where you could adjust. Then the thing would be that you know from statistics that normally this tends to go into the, this would stay there. And MenthorQ and the levels we saw and everything we saw there supports this, because if we breach the call side, then the problem will be that it's very hard for the stock to go down there, because market makers have to buy into this rally and the market repositions themselves. And I want to show you something else which is very important before you set up the trade. We set up a very simple triangle here with all its risk, and before we do that, we're going to switch again to MenthorQ, and we're going to leave the end of day and we're going to go to intraday. Lucky thing is the market is open, and we need to leave the big spider brother and go to our friend Costco here. And you see, this is what happens live right now in the market. Why is this important? When are we setting up this trade? Are we setting this trade up? This is the short volatility trade. And this is no IV rush trade for a couple of hours and closing before the event. No, this is a trade we want to hold through the event, and we should open in the last, let's say, power hour or the last 15 minutes. Sometimes, and you remember Amazon, you open a trade 10 minutes before the market closed and you have a sudden 3% move on the stock, and your position is hard to be calibrated in that moment, but normally the stock stays there. It moves a bit due to the inflation of the IV in the last couple of minutes, but the last 15 minutes, statistically, with a lot of data sets I've looked at and a lot of professional traders I've talked to, is a good time span where you should set up these trades. And the same counts if the market opens and you see you are in profit. The first 15 minutes is good, but this is something for another session where we can talk about management. But what do we see here? Very easy thing is here basically to see the GAX difference for Costco. So what do you see here? Call resistance, yes, 1000, put support 940. So it's a bit higher. We can remember that, but you see here, the GAX has been turning negatively. So the spot price is 430. So we are very close to this put support, which gives us again confirmation what we saw in EarningsWatcher in the statistic, that this could be an event where the market is slightly more negative and doesn't expect a huge move on the upside. But you know how it comes and how it happens. If the market is expecting everything to go bad and something bright happens, then Costco might go up 10%. That's why we try to be non-directional and we try to be basically prepared. And on short volatility, we try not to sell basically naked options if we don't know what we are doing. So again, here you can see GAX decreased here by 64.6%, which is very nice and helps us a lot calibrating our trade. And one last thing, another thing I like to do if I have a stock which normally doesn't move that much, something very easy, but is something you should only do if you know what you're doing, is I talked about that a couple of times. It's a very cheap way, if you really know what you're doing, to set up a calendar trade. The easiest thing would be here, if we said we are in a negative territory, we would use a put calendar roughly 30 days out. If we have open volume, there are On the other hand, you can use the next expiration for the long option. So you play in two time spans, which is always good, and it's a cheap way to participate. And but this is something which, if you stay only in range, and again, where can MenthorQ help us? MenthorQ can help us because, let me go back, it gives us more levels here. You see a lot of levels here. All these levels are sticky. So I expect, let's say I expect we go down a bit, but I want to see if we can stop around these levels here, which we have seen. So let's set up let's take around 940, not at the money, which is always nice, but let's say I'm expecting us to go down a bit, and then let's say we go just out for a week. Let's see, 940. Let's see. You see, IV is differently here, so
I think you need to share back, share the other screen, and then.
Oh, sorry. Yes.
No
sorry. And I made a mistake. This is good. I can show it again. So we have the 940 here for the now expiration, the put, and we just jump one expiration. I normally take 30 days, but it's okay. So you see here, this is a bet, a cheap bet, just $200, $250 roughly, a cheap bet that we're gonna stay in a tight range, and we're gonna go down. But if we see at what the EarningsWatcher showed us that we have a move roughly about 4.3, I would be a risky bet. So this is something I wouldn't put too much money on. This is something also Fabio mentioned and Amin mentioned. And we can wrap that up with this. If we start and see the trades we have here, not this one here. Let me just go back. So the data pick, sorry. This is a trade if you are an EarningsWatcher, which is a short trade, but it's not a prime trade, not a favorable trade. It's something to watch. We saw how we can make this trade actionable. This is a trade which most probably is going to work if nothing weird happens. But the market is always unpredictable. But this is a trade where I wouldn't bet too much. So I know a lot of people who do a lot of earnings. They put, if you are conservative, 1 to 2% of your portfolio into a trade of a very liquid stock. We try to trade only liquid stocks. This is something also EarningsWatcher points out. And then you take MenthorQ to calibrate that. And it gives you like another part of goggles to look deeper. But this would be a trade I would maybe put maximum 2% of my buying power. If I have a trade which is green, I see a lot of things right and properly, a proper setup in the data, then I double check with MenthorQ and the data confirms me. I see the confluence I want to see that, yeah, I would go up to 6% maybe. And these are the trades which really make you money, and they can make you money also after the trade is happening if you use the P and everything. And this is something you can really do. You can combine these two tools to enhance your earnings trades. So, for example, just for a very short second, we can see a long trade, which has here the Accenture, I think the company is called. It's from Britain. Is it Accenture? Yes, I think so.
Yeah, I'm not sure, but yeah, famous consulting company.
Yes, very big one of the biggest around. Yes, so this is something here where we see that normally we would go long. What does that mean? We buy a short straddle, we buy a long straddle, we buy a long, we have a long butterfly, or we have basically a calendar, which is basically a reverse calendar. I wouldn't advise that. It's a bit different. So this is something which is basically long, where we pay because volatility still is high, but we pay because we normally have a move which is higher of the implied, and the beat rate is pretty good. But again, you have the average here, which is above 7%. and the implied is 7.7. And again, we can take MenthorQ data to see which levels are around there, and again see if this move happens. Maybe there is a call wall or a put wall or another reaction zone lower than 7%, and then statistics again would speak against basically putting too much money on that, or maybe you need to adjust, or maybe just buy a butterfly. So it gives you another way of looking at things. I know we could talk for 2, 3, 4 hours and deep dive into all these things, and earnings season is going to kick off properly soon. This is basically more of the drift toward this next earnings season, but I hope you enjoyed what you saw, and it was a bit helpful to just take a glimpse of parts of things I do. This is just little parts of what I do with these two platforms, but I think this is something you can really, really combine, and these are very tools I use every day. And I can't advise you to buy them, but I've become a far better trader with these tools, and I wouldn't miss them for anything, at least for my earnings and all the other stuff I do.
Thank you, Dan. This was really great. I really loved basically this back and forth and how you combined really two sets of data, two platforms. And it's really very straightforward and understandable, basically, how we build this step by step, look at the right data. And as I'm sure the audience noticed, the key point here is that, you know, we're really agnostic and just following the data. There is no, say, you know, a personal add-in of I feel that it's going, or I read in the news or things like that. This is really the most agnostic, being guided by the data. And, you know, it's funny how users of platforms can push the platform even further by these, with combining it with different other tools. So I really loved your demo. Thank you very much for doing it. And obviously, we knew that you'd make for a great demo. You're exactly in that position of using both tools, both platforms in a very comfortable way. So props to you, and thank you again.
Yeah, and I think to add to that, we want to share your website. And I think for our audience or for your user, you also has a special promo code for today. So if you guys are interested, you can go on EarningsWatcher and apply coupon code ER20. You can speak about it. I'll let you.
Yeah, so you can get, guys, 20% off using ER20, basically on all of the memberships. And basically become like Dan yourself and follow this work through. So yeah, we'll be happy to have you over. And of course, so we're also very community centered, a lot of discussions, a lot of tips. We really go the way of same as you guys do with MenthorQ. We give you the tools, we give you the data, we help you to use it, we help you find your own edge, and then in the community, the discussions, the live streams, etc., to help you get up to speed. But really happy to do this collaboration with you guys, because I think we're aligned philosophy-wise of how to trade, how to use smart data to trade, get your own edge, and study your own data. So take advantage of that 20%, and happy to have you with us.
Yeah, and we also have a special thing for you guys. So if you interested in MenthorQ, you can also get 25% off with the coupon code LIVE25. So just follow the link on the YouTube channel, or apply this coupon at the checkout. And then, of course, as of 1st of October, we're going to restart our weekly live events. So we're going to have a lot of live sessions, probably on X as well. So stay tuned. The goal is really to help you guys get more comfortable with the data and be able to be actionable and use the same approach used by institutions. So together with those tools, you can actually now make smart decisions as like a large institution would do. So I think it's very, very important. I want to thank you, Dan, of course, as always. And I want to thank you, Amin, for joining us. This was very great, showing us what you guys have developed and show you how you can then apply together these tools. So very excited. And yeah, we'll do more of those. And thank you, guys. And if you have any questions, please send them over our Discord channel or our email address, and we'll be happy to answer.
Thank you. Thank you, everyone. Thanks, guys.
Yeah, thank you very much. And we're gonna have more stuff. We have the VPR, VRP with Fabio, and earnings are hitting off. So stay tuned, and yeah, let's be successful and
Lots of
consistent.
fun.
Thank you. Yes,
Thank you.
and thank you both for having me. And this was exciting, and as always, much fun. Enjoy, guys, and back to the market.
Bye.
Thank you. Bye.